Hello, it's Tom from Hedge Fund Tips, and welcome to our VideoCast episode number 6 for the week ending December 6, 2019. So the first subject of this week's VideoCast is the article in the Financial Times written by Jennifer Ablin, the U.S. markets editor over at the Financial Times. And she did an article about big name U.S. investors take aim at beating up energy sector. And I was honored to be included to have a couple quotes in her article. And she really did an incredible job outlining the number of legendary investors, billionaires that are entering the sector. Warren Buffett with the Oxy deal. Carl Icahn's got about $5.5 billion of energy stocks in his portfolio as of the end of Q3. Jerry Jones with his billion-dollar deal this summer in the natural gas industry. And looks like he's doing another billion with Chesapeake. And Sam Zell is now buying assets in Texas, Colorado, and California. So she outlines how it's been the worst performing sector of the decade, and many people are adverse at this point, and sentiment is despondent. Valuations are at historic lows. She gets a couple quotes, and here in the middle, I point out that there's been a relatively quiet strategic movement into energy by a group of billionaires, and she does a good job outlining that. And the other point I make is the energy sector is one of the top 3 sectors for expected earnings growth next year, coming in at number 1 with 23%, ahead of industrials at 17% and materials at 15%. Coincidentally, they were the worst performing sectors for 2019. So the last shall be first for sure. And certainly coming off of easy comps doesn't hurt either. So also in the middle of the article, she talks about how I'm interested in E&P names because they'll have the most juice because they have the most leverage to the price of oil. And she names a bunch of E&P names. For clarity, where our exposure is in the basket, there's an ETF called XOP. And as far as individual names, we also have Occidental. This list that she has here is just a sampling of what exploration and production names are, not necessarily the ones that we're in. Sam Zell gave a quote about why they're lending where capital has stopped flowing, which is part of the supply-demand equation we'll get into in this video, but quite an honor and very humbling to be quoted in the same article as legendary Sam Zell. They call him the grave dancer, by the way, because he has a history. He's made his billions buying in distressed assets and sectors when no one else is interested. So it's a nice vote of confidence to see him stepping in, as well as Warren Buffett, who has made a habit for 50 plus years to not do commodity-based companies. But it seems to me, not only did he do the preferred, which is just a nice yield and a senior position, but he just added another $300 million of equity. So it's kind of communicating that, and when he did the deal, by the way, they asked him, why didn't you just buy the whole company? And he said, well, if Anadarko had come to us first, we very well might have, which implies that with his $128 billion cash, it's not out of the question that he could start buying companies if the right opportunities present themselves, because that's probably one of the few sectors where you can truly still find incredible value with the market up. So, and then Bill Gross is also in the sector, but Bill always likes yield, so he's in some MLPs. And finally, I talked about an interesting concept. We're going to drill down into this in the article I have on our site. But I said investors need to think about the E&P subsector like a portfolio of high-yield junk bonds. All the managers are afraid of the sector because of defaults. And like in life, what you fear most rarely comes to pass. And even if it does, it's usually a turning point for the better. So, Michael Milken literally changed the world in the 80s when he went to portfolio managers and he said, look, you've got a basket of investment grade bonds yielding at that time probably 7 or 8%. I've got a basket of junk bonds. I'm sure he packaged it differently, high yield bonds, that is yielding 15%, but in a recession, 15% could default. So your net return after defaults is going to be about 12.75 or whatever it is, and you'll recover on any defaults in liquidation. So net, you're going to have dramatically higher returns. And he went to insurance companies and portfolio managers around the country, and he raised billions of dollars. He was a billionaire maker. I mean, he made and I'll go through the list later in this video cast, but with that concept, it's risky to buy individual E&P companies or individual junk bonds. But when you have a basket and you factor in the worst case scenario of a 10 to 15% default ratio and equity getting wiped out, the 85 that are left, in this case in the stocks, they can be up 100, 200% over the next 3 to 5 years. So that's how we're thinking about it. So rather than fearing the defaults, embracing it, know that they're coming, and then say, well, what's going to be left after the market clears? What are the remaining names going to do? And past as any prologue, they can have tremendous runs. So that was the concept there. She was nice to acknowledge the biotech bet that we made in September. That's just been a monster, and we're grateful for that. And lastly, the famous quote, we've seen this movie before in the early 2000s, and it has a very happy ending. So we'll get into that further. So go ahead to the Financial Times site, take a look at that. Jennifer Ablin, U.S. Markets editor, really grateful to be a part of her great article this week. Next, you could also find excerpts on our site if you have trouble accessing it there. You could simply just click on this and it'll have a link to these excerpts only. If you want the full article, go to the Financial Times at this link here. So now for this week's stuff, we're also going to cover the energy market this week and the general market as we do on a weekly basis. And this week's article on Thursday we put out when there was still uncertainty about the OPEC result, the Taylor Swift bad blood energy market and sentiment results. And it's funny, obviously, to associate Taylor Swift with the energy sector, but the lyrics from her song are perfectly appropriate for the sentiment in the industry. And one of the things that she says, you've made a really deep cut and now we've got bad blood. And I'm going to walk you through how the energy sector has burned so many portfolio managers that they won't touch it with a 10-foot pole until it starts to run. But right now they won't touch it with a 10-foot pole. And the other line I love in her song is Band-Aids don't fix bullet holes. Brilliant line. And that's basically what is happening when portfolio managers think about adding some of these names to their portfolios, having been burned in 18 and then this year, and with it being such a small percent of the S&P 500 at historic lows, 4.2% sector weighting in the S&P 500, most managers are like, I've had enough. I don't want to take the risk. I'll just overweight tech and do it that way. But to give you an idea, when you consider the weighting, when the energy sector, not E&P now, when the energy sector peaked in June 2014, peaked in price and capitalization, since then, it was about 12% in that range of the S&P 500. And if you look at now at 4.2% of what the value of the S&P is, managers have basically pulled about it's like shy of $900 billion, $865 billion of equity from the sector. Just pure despondency, and probably justifiably so in the short term for certain. But we're going to talk about why it might be turning and some things to look at that people may start to recognize in coming weeks and months and years for sure. So in the beginning of this article, we talked about, in recent weeks, the general market was showing, short-term overbought signals. We got the nice pullback earlier this week. But the antidote to that short-term overbought was, with a lot of things that have come up, like biotech has just had a monster run since September, over 25%. Some of the names are up 50 and 100%. It's just been unbelievable. And the thesis for biotech was similar. There was a huge amount of political noise in September with the Democratic debates, Medicare for all, drug pricing, etc. And what we noted in our September article, which you can look up on the site, just look under biotech earnings, and it's the first or second one down, was that earnings estimates were going up about, I think it was 9.5%, and price was going down the equivalent. So there was a huge divergence. The fundamentals were getting better in the sector, and the price was just going down because of the overhang, the political overhang. And we said, this looks like a great opportunity. And the same thing is happening in the energy sector. There's so many reasons why managers hate this sector, from political, economic, sustainability, climate, etc. But the most important reason they hate it is because it's not working. Okay, and they're not making money on it, and it's such a small weight they feel like they don't have to have exposure, and that will change when you see the reversal. But let's take a look at why there's such, quote, bad blood in the sector. So the problem for most of them was when we had the depression. This was an oil depression in from late 14 to 2016. I mean, look at this. This is a chart of the exploration and production sector. Fell from, call it 80 down to 20. So by the time they realized that the sector was rebounding, WTI crude had gotten down to $26 a barrel here. And some of you will remember, one very famous pundit said, it's going to 10 and I'll never see over $44 a barrel again in my lifetime. So that was literally right on this bar here. And that's where sentiment was at. And by the time institutions, as they were puking out stocks during here, by the time they turned around in late 16, the rebound was already 105%. So many of them just started getting long exposure here just in time for them to open the trap door and dump them out. And then you had another collapse from 43 down to 28 for the sector. So they absolutely got burned. So it was, fool me one, that's not fun. 100% move they missed. They get in, they say, well, we've got a lot of room to run, and boom, trap door. Same thing happens the next year. Fool me too, shame on you. So here we are in 17, it goes down, they start to get exposure, maybe this is the time. Many of them say, I'm not going to fall for that again until it actually breaks out, and they all chase it, and boom, the trap door opens again. Fool me too, shame on you, and now fool me three, shame on me. No one wants to have exposure. We're down to 2016 lows, the oil depression, and 2009 great financial crisis lows. And what's the difference here is that, in the great financial crisis, WTI crude traded down to $33 a barrel. Here, WTI crude traded down to $26 a barrel. And here, we're at $58 a barrel. So that's number one. Number two, if you take the top 30 weights of the exploration and production sector that have comps in 2009, the earnings power has increased by about 32.4% as of give or take a month ago when we wrote the article. You can search for any article here. It's called Snake Oil. It's probably enough to just search by snake oil, what portfolio managers think about the energy sector, something along those lines. And so basically from here to here, earnings power has gone up for those top 30 weights with comps, 32.4%. What that excludes is today, the earnings power of the top 30 weights have expected earnings growth for 2020 of 24.59%. You can find that under exploration and production earnings revisions. You can just click on that to look that up for yourself. So you take 24% plus 32%, let's round number it, let's call it 55% of earnings power between here and here, that in 2020 inclusive, that's not accounted for, and yet the price is in the same range and oil is nearly double the price. So the analogy I would say is, what if you bought an apartment building in 2009 during the crisis for $1 million that yielded $100,000 in rental income? And today, you figured out that you could buy the exact same apartment building at financial crisis levels for $1 million. The only difference was that asset, rather than producing $100,000 of rental income for you, today it yielded $155,000 of rental income, but you could buy the asset for the same price. And that's the way that I view the exploration and production sector today. And with energy, I believe, stabilizing now with the OPEC cuts, they've cut another 500,000 barrels. So from now through March, they're going to be cutting 1.7 million barrels a day, or 1.7% of global production. You're going to have stable pricing. And for most of these E&P producers, even the marginal ones, their break-evens are below $40 a barrel. So that's really, really constructive. So that's basically where we are on that. Here's the snake oil article. You can just click on it here, actually. And Taylor put it best. Band-Aids don't fix bullet holes. They got burned here, then they got in, got burned, got in, got burned. And when else could you find an example like that before? Well, let's try 2003. A very similar setup happened. So this is now the Dow Jones U.S. Exploration and Production Index. And basically, you had a huge crash here, very similar to here, with oil prices coming down. We don't have the Exploration and Production Index, but it was in line with this. If you look at the General Energy Sector Index, you'll see that it was down materially in 98 and 99. Then you had this huge rebound in oil, similar to here. But what was happening in the exploration and production sector? You had a big drop, then people reluctantly got in, opened the trap door, reluctantly got in, opened the trap door again. Got in, trap door, got in, trap door again, people despondent. The other thing that's very interesting about this analog is that in this last phase, even as oil prices were going up, people didn't want to invest in these exploration and production stocks. Oil going up, the sector just languishing. Here, oil going up, the sector just languishing. So history doesn't repeat, but it does rhyme. The level of despondency at these levels was huge, and it preceded what was the greatest secular bull market in the energy sector in history, 649% gain. I'm not calling for anything like that. This was driven by emerging market demand. And I will say, though, with emerging markets having languished, the emerging market chart, by the way, looks very similar to this oil chart. It's been sideways for 10 years. The demography of that with the birth rate and the emerging middle class is similar, that you could see some material demand, and if not something like this, obviously, certainly something monumental and of significance over the next 3 to 5 years is what we're looking at. So that kind of gives you a historical perspective on the exploration and production sector relative to oil prices. And the next concept is, so why are managers so gun shy? It's not just emotional and just sentiment. They're scared about the leverage on the balance sheets, number one. And number two is Wall Street's newfound reluctance to lend to the sector, because up until now, they used capital to produce with reckless abandon. There was zero capital discipline. And Wall Street's now demanding capital discipline, cash flow production, and return of capital to shareholders before they'll open the vault to the wildcatters once again. So as a result, we're seeing rig counts are down 25% year on year, which is going to affect the supply-demand equation and put a nice bid under oil. You couple that with OPEC. You couple with the cuts. You couple with the fact there's zero security premium in the price of oil. And we saw what happened a few months back with the Aramco attack. So a lot of things here are supportive of prices certainly stabilizing and starting to go up over time. And that's not in the forward curve yet. So that there's multiple opportunities. So the fear on behalf of the managers is default. And if you're picking individual E&P names, I totally agree. You've got to get it right. Otherwise, you could wind up with a donut hole. So as we started talking about before, you have to think about this sector like a portfolio of junk bonds. While 10 to 15% may default and go bankrupt, the other 85 to 90% are going to dramatically outperform, and they can be up 100 to even possibly 200% over the next 3 to 5 years. So, you have a couple options. One, you could buy the large integrated names with no defaults, quote unquote, the investment grade companies. and maybe they'll appreciate 30 to 50% over the next few years, probably outperform the S&P 500. Or option two, you buy a basket of exploration, worst case scenario, 15% default, the other 85% work, and you're net up, 85% over that period. And no one can predict the future. All the disclaimers are on the site, but this is just looking at history as past as potential prologue for the future and making, risk-adjusted bets. Obviously, you're not going all in, or we're not going all in, but a portion of the portfolio, probably certainly greater than the sector weight in the S&P at present. And I know many managers are starting to get overweight. Like Lee Cooperman's last file, he was filing before he went to a family office. He was 200% overweight. We'll talk about some of these people with exposure. So that was basically Milken's concept, is a basket, and because of that, the result of that is with his ability to go out and raise billions of dollars, saying, yeah, it's riskier, but even after defaults, you're going to get a better return. He got the financing to build what is modern day Las Vegas, and he was a billionaire maker. Because of him, Carl Icahn became a billionaire, Steve Wynn, T. Boone Pickens, Rupert Murdoch, Craig McCaw, John Malone, Ron Perlman, Ted Turner, among others. So what he did was revolutionary, and I see a very similar opportunity here. Buying a basket like an XOP, like certainly a group. Don't just look at one or two or three, because that could be risky, because you're still going to have some defaults moving forward. The other way to think about it is, in 2009, in the great depths of the financial crisis, what was the last thing that most people wanted to buy? And that was banks. And who was out buying them? Billionaires like David Tepper, Warren Buffett, John Paulson, etc. And they made fortunes, 100+% moves on the rebounds, 2009 to 2010. Then you had the single-family home foreclosures were at a peak in 2009 and 2010. What was the last thing everyone wanted to buy? Single-family housing. Who was buying them? Billionaires like Steven Schwarzman were buying packages of thousands of single-family homes during this period and renting them out. So now that everyone's dumping their energy holdings, who's buying? Again, billionaires like Warren Buffett, Jerry Jones, Carl Icahn, Sam Zell, Tom Barrack, Lee Cooperman, Richard Kinder, Harold Hamm, Bill Gross, and Kelsey Warren. So, they know quite a bit about what it takes to make outsized gains over time. So Buffett's got the $10 billion preferred and $300 million equity on top of it in Oxy. Carl Icahn owns $5.5 billion of energy stocks, CVI, LNG, Oxy, and Sandridge. Sam Zell's buying the assets themselves because he's more of a private equity guy in California, Colorado, and Texas. Barrack's joining him. Jerry Jones did the $1 billion deal through Comstock this summer, wants to do another $1 billion of Chesapeake's assets. Richard Kinder bought $130 million of his own stock this year alone. KMI is the stock. Harold Hamm bought almost $79 million of his own stock this year, Continental Resources. Kelsey Warren bought $45 million of his stock, ETP. That's his biggest ever purchase. And even Bill Gross is buying MLPs, and energy is his favorite sector for 2020, according to the Financial Times. And Lee Cooperman has recently been out talking about WPX Energy. So successful people look for opportunities in difficulty, while unsuccessful people tend to look for difficulties in the opportunity. Or as Warren Buffett always says, be fearful when others are greedy and greedy when others are fearful. This is from Thursday during the OPEC meeting. The amount of and by the way, this is not a shot at CNBC. They're reporting the facts of what's happening. So energy's got a debt problem. Check. That's true. There's max pessimism in the market. Check. Okay. So he's reporting, doing a good job here. I would be doing the exact same thing in their shoes, reporting the news. Brutal error for energy. Another one. Check. That's true. Here, Wilfred doing a good job. Energy on pace to be the worst performing sector of the decade. Absolutely true. So this is not a knock on them. They're doing good reporting. This is factual. Energy's down 5% in 1 month. Check. But this is the level of pessimism. And while all this is going on, and this is fair and accurate reporting, billionaires are in the market buying. So I want to be alongside them, and they take long-term views. That's the other thing too. So if it's down in a month and you're puking it out, they're probably in the market buying more. So what were the potential catalysts on Thursday we were talking about? We said the OPEC meeting. We didn't know what was going to happen, and we were certainly happily surprised by the extra. We certainly thought an extension was in the cards, but an extra 500,000 barrels was a nice surprise and was certainly in the interest of all the parties involved. Next is the Aramco. They did their IPO, very small float, by the way, and they got towards the top of their range, I think $1.7 trillion valuation. The only way they're going to keep that valuation up and be able to offer more and more stock to the public is with the price of oil remaining stable, and if not going up a little bit. I've always said the sweet spot on WTI crude is 58 to 72. That's when consumers win and producers win. You get above 72, the consumer loses. You get below 58, the producer loses. So 58 to 72 is really the sweet spot. And the future of Saudi Arabia and its political stability depend on the success and ongoing valuation of the stock in coming months and years as they offer more and more of their stock, the Aramco stock, to the public to diversify their income stream. So they have a serious vested interest in keeping oil prices stable, and that means they'll cut if they have to. But, with all the rigs coming off 25% year on year, the capital discipline, I think the equation is changing dramatically here, and they're not going to have to do a whole lot more cutting moving forward to keep it in the sweet spot. Okay. The other thing is, if the U.S. producers want cash, they're going to have to return. They're going to have to show that they can return cash, which in many cases means just shutting down some of their rigs and returning cash in the form of buybacks and dividends. And lower production and fewer rigs will start to impact that equation and further improve profitability in the intermediate term. The other thing, the fourth point catalyst, was shale wells have a steep decline rate relative to conventional wells. They gush in the first few months, but by the end of the first year, the production is down 60%, or 10 times the decline rate of a conventional well. So as financing for new shale wells becomes harder and harder to come by and supply declines, cash flows from existing wells will abound and return back to shareholders. 2/3 of U.S. shale oil comes from wells drilled within the last 18 months. So as the pace of those wells decline, price is going to be the beneficiary, as well as the margins on the remaining rigs. And lastly, the energy sector is projected to have the highest earnings growth of any sector in the S&P in 2020. Last shall be first. We covered that. And sixth, this is the most important in my view. This is sentiment. And as I stated in the snake oil article above, for a number of factors, portfolio managers won't touch these stocks: environmental, sustainability, political, fundamental, de minimis weighting in the S&P 500. And this is the most important reason of all. They're not working right now. You're going to be amazed how quickly that sentiment's going to change overnight once they start to run. Politics be damned. So something to keep in mind there. As for our normal weekly indicators, now we're going back to the general market here, as we do on a weekly basis. The AAII sentiment survey results. The surprise there, so bullishness came down a little bit. We did have that pullback early in the week, which we were looking for on the short-term basis. Bearishness also came down, which is odd for both of them to come down. What went up? Neutrality. And the last time neutrality went this high was October 3rd, which was the exact bottom of the pullback during that period. And sure enough, we bottomed on this pullback. So that was a helpful indicator we put out on Thursday. The fear and greed had confirmed that the euphoria had come in a little bit. And the active investment managers are still underweight here. So with a 300 plus point rally in the Dow, and 30 plus, I think it was 30 some odd points in the S&P, on Friday, they're going to have to get this exposure up quickly into year end for the last 3 weeks. So, and finally, I made a note here on Thursday when things were looking pretty grim about the phase one deal. Every day that goes by without phase one risks the erosion of 2020 earnings estimates, which is, the basis of price. Price is predicated on earnings power and the multiple applied to that earnings power. So for now, we're holding strong at 9.9% earnings growth. I think actually it's down 9.8% as of yesterday. We'll look at that at the end of this. But what could be a positive surprise is that estimates actually start to improve if a deal is done sooner than later. And President Trump intimated later in the week that something would happen on the 15th. Hopefully that means something positive. Certainly something will happen on the 15th. We know that, but let's take the positive side as the markets seem to. And it's certainly in President Trump's interest with re-election, business, and because he campaigned on it, most importantly, business interest and Main Street's interest and Wall Street's interest to keep estimates up. Now, here's why the deal is in China's interest, okay? Getting a deal done now versus holding out. If you look at electionbettingodds.com, this blew my mind, okay? So if these odds hold over the next 11 some odd months till the election, I don't want to be China without a deal, because at the end of the day, if nothing changed today, he would get elected tomorrow. A lot can happen in a year, that's for sure. But if I'm China, I don't want to take that bet with these odds, okay? Any reasonable investor, trader, gambler would not bet against this today. That's not to say it couldn't change, but today. And if they don't sign this phase one deal now, sooner rather than later, because the closer he gets, the less incentive he has to do it, then after the election, if they don't have a deal, they're toast. I mean, bottom line is, if he doesn't get a deal with them, a win-win deal with them before the election, and these odds hold and he gets reelected, he doesn't have to concede on anything. He has nothing to lose. Right now, they can get a good reciprocal deal. They can sign it up quickly and everyone wins. Trump wins. China wins. America wins. The rest of the world wins. But they dilly-dally on this and he gets reelected, and, without any concessions, it will further devastate their economy and lead to massive political upheaval, much more so than what we've seen in Hong Kong in recent months. So I think everyone is mutually lined up to benefit from getting this thing inked in the next week or so, or a couple of weeks. And once that happens and businesses have that clarity and vision, keep in mind, this is not really priced into 2020 earnings, a decent deal. So you could actually see estimates start to go up once companies can start to plan and start to invest and start to see more and more CapEx. So I like that setup. It's really in a position that everyone wins by doing something now, and that is likely to happen. So now we've moved off of energy. I'm just going to cover a quick few things that we did over the week. One of the most interesting stories I've ever read that I'd never heard of, and you can find it here, the November 30th, what I'm reading today, the greatest value investor you've never heard of. It came from a site called Macro Ops, and the guy's name was Floyd Odlum. And the interesting thing about Floyd, he's a deep value investor. He came out of the gate and he immediately proceeded to lose $40,000. Not some of it, 100% of it. And in today's dollars, that's $500,000. So for those of you who haven't been the most successful right away, everyone pays their tuition to the stock market initially. The key is, do you learn from your mistakes? Do you keep an open mind? Do you continually try to improve? And Floyd certainly did. So after he lost that, he was able to pull together another stake of $39,000 and to start a partnership. And over the next 6 years, his compound annual growth rate from buying very cheap and distressed stocks, maybe he would have been a buyer of exploration and production nowadays, who the hell knows, but his compound annual growth rate was $2,547 over those 6 years. And over his career, he went from $39,000, which is the equivalent of $500,000 today, to over $150 million of controlled assets, which is just billions and billions of dollars adjusted for inflation today. He did that in a period of 12 years. So you definitely want to read his story. You can go in the search bar right here and just type in greatest value investor you've never heard of, or go to this Macro Ops website. But amazing story. I've been in the business for a while. I've never heard about him. This is a picture of him. Check that out. I think everyone's really going to enjoy that. I certainly did. Next, we did industrial sector this week. The key takeaway there is they're the second highest earnings growth after energy for 2020, with top 30 weights that we measured here was 15%, 15.28% growth. The next one I want to cover is on December 3rd. We put out a nice article from CNBC. Here's a full list of every book Warren Buffett has recommended in this decade in his annual letters. You definitely want to check that out. You could either go to December 3rd or just, again, hit the search bar and type in, Warren Buffett book or recommended books or something like that. It'll take you right to it. His top two are The Intelligent Investor by Ben Graham, which he credits for most of his success, if not all, every time, probably at his annual meetings. And then the second one is Charlie Munger's Poor Charlie's Almanac. But there's about a dozen or so books. You definitely want to check that out for a reading list and maybe some holiday gifts. Next, I like this trend. Japan launches $122 billion stimulus to fight trade risk. So as we've covered in recent weeks, monetary policy is pedal to the metal. U.S. is back on board. EU's back into QE. Japan's never left the game, but now they've also started the path with fiscal stimulus, $122 billion. It's about time. Germany should be next for sure. And, it would be amazing. I'm not holding my breath. Could we get an infrastructure deal done in the U.S. in the next 12 months? Would be absolutely phenomenal, but we'll take it day by day. Next, what was covered here? Chesapeake actually did a debt deal, rolled out some of their debt to stave off bankruptcy. The stock was up this week. The other thing about that is they're also in talks with Jerry Jones to sell $1 billion of assets, which will give them massive liquidity. They've got quite a few assets, so it might not be the end of times for Chesapeake just yet. It was nice to see that. And lastly, we talked about the additional 500,000 barrels. We also covered the consumer discretionary sector. The key takeaway there is the earnings growth for 2020 will be 13.46%, another big jump for that sector. And then finally, we talked about overall earnings holding in strong this week at 9.8% growth, or 178.57 per share for 2020. This is the first time we're going to have a material jump in earnings growth since 2016 to 2017, when the market rallied mid-30s. I think it was about 37% over 15 months. It'll be led by The Last Shall Be First. The worst three of 2019 will be the top three earnings growth of 2020. Energy, industrials, materials is consensus. And not only did U.S. hold strong, but Europe held strong, with 3 out of 4 quarters hovering around double-digit earnings growth for 2020. And that's a story that no one's focused on. Much better than expected when you take a look at the last few quarters, -2, -2, -4.5, to have that type of rebound. So that's it for this week. I hope it was helpful, and enjoy the rest of your week. See you back here next time.